Yo, wanted to go over some things. Thing is, people think this time is different now because the stock market keeps pushing to all-time highs, and they say that the yield curve is a boomer indicator. It doesn't matter anymore, right? But the reality of the situation is, look, it inverted here in 2006, okay? And the stock market in orange, how long after the yield curve inverted did it make new all-time highs? This is where the yield curve inverted. So let's do a time measurement from over here until the peak of the stock market. The yield curve inverted in January 2006. The stock market peaks in October 2007. 650 days later. Well, the yield curve is sustainably inverted here, just like it's sustainably inverted here. Yeah. And 644 days out, where does that put you? If the exact same thing plays out in April of 2024. So how can you say so far that this time is different? You could have said the same thing over here, right? You could have said the yield curve, and you are warning of that. They're clearly wrong, right? They're clearly wrong because here in January 2006, it's warning you of something bad to come, right? And the stock market makes new all-time highs in October 2007. People don't want to hear about it because it's a shit indicator, right? It's pretty simple. It's useless, is it not? Oh wait, what came after wasn't so great. But again, these things take such a long time to play out. Sometimes it's a long process that varies. It can take 6 months, it can take 24 months, right? Anywhere between. So again, from the inversion of the yield curve right here till the bottom of the stock market, you had to wait 1134 days. Where would that put you if you had to wait that long today? August 2025. Now look, I made forecasts thinking the stock market was not going to make new all-time highs, and I've been wrong. I thought the stock market was going to go down here. I thought that there was going to be a little bounce. You can go back and watch my videos, but I did not think it was going to take it that high or that high. Okay, I thought that it was going to go down here. Okay, instead it reversed. Does that mean that the yield curve is wrong? No. It means that I was wrong in the short term about my price forecast. Yes. If that's what you want to hear from me, yes, I was wrong about where price was going in the short term. Absolutely. But that doesn't take away from the big picture, right? You can sit there and say, oh, well, the yield curve being inverted, the stock market is all-time highs. No one cares about it, bro. Well, it was inverted right here, and the stock market was at an all-time high. It was inverted here, and the stock market was at an all-time high. It was inverted here, and the stock market was at an all-time high. Yeah? It's inverted here, and the stock market is an all-time high. So what's different? Of course, nothing is different. It's the same thing, right? Now I'm gonna go over a couple of things on my Twitter, okay? And it's really gonna put this into perspective for you, okay? Number one, I guess we can go over this one. Home price to median household income ratio in the US, okay? So how long does it take for the average household to save up to buy a house? Okay, the average is around 4. Okay, we're above 7.5, or yeah, we're around 7.5. So just for home prices to get back to where they would historically be, if they weren't in a bubble, they would have to crash 50% in real terms. Okay, here's another picture showcasing how insane the bubble is. Here's the 1929 bubble with PE ratios, the dot-com bubble, and the 2021 COVID bubble, and now we're back up here. Okay, because this picture's from 2021, or well, 2022 after the fall, I suppose. But the point being is here, you can see it. What's different? What about this one? Buffett indicator, market cap to GDP. Do you see how extended we are? Or the favorite one that I really like, which is this one. Hours work to buy the S&P 500. The purple line is the average over time. It's around just over 20 hours. We're currently at 120. So now what we're gonna do is we're gonna go over. Um, Actually, before I do that, I want to go over what the yield curve actually signifies. It's actually very simple. Okay. Every single time that the yield curve goes below the red horizontal line here, what does it signify? If you lend your money out, I'm going to try and explain the yield curve in the most simple way possible for people to understand and why it has such good predictive power, but it's also causative. Okay, I'll explain both reasons for both of those two things that I just mentioned, both the predictability of it and the causative thing, right? If you lend your money out to your friend for 10 years, you would expect a better return than for 2 years on an annualized basis. Why? Because there's more risk associated with lending your money out for 10 years than 2 years. Why? Because there's inflation risk. You might have the risk of he might not pay you back. Whereas if you lend it out for 2 years, you wouldn't necessarily expect a better yield. Well, that's the thing right now. You're getting a better yield for lending your money out for a short period of time. That only happens right before economic downturns, which again, you can see. You can see it every single time. Before the stock market crashes, okay? The yield curve is inverted. 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 And the yield curve is inverted. Okay? So what happens? When people are concerned, and we're not talking about you or me or retail investors, we're talking about billionaires, the wealthiest people in the world, the people who have access to information that you and I don't. What do when they think a crisis is coming? They'll buy the long end of the yield curve, as in the 10-year treasury, because it's a safe and most liquid asset in the world. Okay? What happens when you buy it? The price goes up and the yield goes down. Okay? This right here takes the 10-year yield on the US Treasury, the 10-year US Treasury, and subtracts it with the 2-year US Treasury yield. Okay? And you get the spread, the delta between the two. Okay? The difference between the two. If it's below this line right here, it's inverted. Why does that matter? When a bank, how does a bank make money? They borrow money short term and they lend it out long term. Can they make money right here? No, they can't. The banking business model doesn't function when the yield curve is inverted. Okay? So not only does it tell you how people are positioned financially, the wealthiest and the wealthiest people in the world who also have insider information, but it also tells you that something is wrong with the banking system, right? At that time. And it also tells you that not through their words, but through how they're positioning themselves financially, you're able to see if they're concerned or not. So if we take this as like a sign of concern, right? Here they're pretty concerned, right, about what's coming. Here they're pretty concerned about what's coming. Here they're pretty concerned about what's coming, right? Here they're pretty concerned about what's coming. And here, what do you take this as then? Do you think that this is fine? Or do you think they're extremely concerned about something? Look at the depth and the severity of this. This means that everyone was buying the 10-year treasury, pushing down the yield. Inverse correlation between the price and the yield, right? And therefore it inverts the yield curve. Okay, so what's the track record for this? The 10-year 3-month, 8 for 8. The 10-year 2-year, if you want to be exact, it's actually 10 out of 11 since World War II. What was the exception? Going back to the mid 1960s. What happened back then? We can go back and look. The mid 1960s was right around here. Did the stock market still fall here? Yeah, it still fell 24%. GDP contracted from 10% down to 0.1%, but you did not get a recession. So yes, this time the 10-year 2-year was objectively wrong. It's still called a stock market 24% decline, and that GDP was going to go down, but it didn't get the recession call correct. Okay, that's the only exception. So for people to bet on this time being different, you need to understand what that would imply. Okay, it would mean that the business cycle has been repealed, reality has changed, interest rates no longer matter, which are crazy things to bet on. Okay, and the same thing that they were saying the same thing over here. Look at this. U.S. economy on track for a soft landing. Dallas Fed, September 26, 2007. U.S. inflation pressure easing and the economy should manage a soft landing. The Federal Reserve Bank of Dallas said on Wednesday. Look here. They report Q4 GDP increased at an annual rate of 0.6% in the fourth quarter of 2007. And then what do? They revise it down. The department sharply revised its estimate for its fourth quarter performance to show GDP contracted 0.2% rather than growing at 0.6% as it previously reported. Or you have other people on my Twitter, like this guy, who again cannot back up what he's saying, right? Look what he's saying here. I show this, right? And he goes, this time is different. Time in the market beats time in the market. Eventually you'll be right. I'm like, it's different because Mr. Jonas on Twitter told me that it's different this time, along with the yield curve that has a flawless undefeated track record that also points towards the same thing. Centuries/decades of undefeated data. It's actually the exact same. Lol. You just don't get it. Look at the time between the inversion of the curve. 650 days for the inversion of the curve till the peak of the stock market. We're just south of 600 days. Yeah? Or just shy of 600 days. Look at the time between inversion of the curve to the peak of the stock market. Don't talk if you haven't even looked at the data. It took 640 days last time. We're around 600 days now. Think I'd rather trust the billionaires in the debt market that are always right and have tens of trillions or trillions and tens of trillions on the line rather than a four-figure retail investor on Twitter betting on this time being different. Maybe that was rude. Whatever. The point is, this guy has no data to back up anything he's saying. And no, time in the market does not beat time in the market. It's the dumbest NPC thing to say. If you get out when the yield converts, you always time the market and beat the market. Why do you talk when you can't back up what you're saying? Yet I do. And I show it here. Show me the time where timing the market didn't work with looking at the yield curve. Why do you say things that are factually wrong? And of course, you're not going to have any answer because you don't back up what you're saying with facts or data. You just say things that are objectively, you just say things and it's objectively wrong/misleading. Next time, show me a chart that backs up what you're saying like I did. Otherwise, you look like a moron. It's simple. Every single time the yield converts, again, they can go up for a long time, for a year and a half, almost 2 years. This path right here is the great financial crisis path after the yield converted. And the red line is where we are today. Well, you could have said the same thing over there, right? You could have said the exact same thing, which is again what I brought up over here. It took 644 days for the stock market to peak after the yield converted. Do I know if it's going to be 6 months or 24 months before, like by the time it inverts? No, I have no idea, and I'm not going to sit there and find out, right? And number two, before some genius says it, like, yeah, but then you're going to miss out on it. Bro, listen, I actually can sit on the sidelines and bet on this time not being different. And it's very simple. Why? Because, again, look at my equity curve, right? Trading is gambling, okay, but how am I green? 35 out of 36 days is all about luck, okay? Other people will not show you their equity curve because it's not something you can alter, okay? So you can sit here and say, like, yeah, but you're getting outperformed by the market, whatever. No, number one, I'm not getting outperformed by the stock market. Number two, yes, BTC has outperformed in the past year plus. Yes, it has. But in the past 2 years, it has not, okay? I've severely outperformed it. So you can sit here and say, timing the market does not beat time in the market. Well, I just disproved that thing, okay? And number two, I know how to trade, right? And again, you can sit there and say it's gambling. Well, clearly I'm doing something that's making me green 35 out of 36 days. And here you go. You can see it's literally everything is the same here. It's me, right? You can see it. Everything is the same. Okay. So now what we're gonna do is we're gonna look at the comparisons between now and the Great Depression, the Roaring Twenties, which led to the Great Depression. Again, before I go into this, I wanna give some uh, credit to a guy called Blockchain Backer, which is the guy that has been talking about this ever since 2020. He was bullish during the March of 2020 crash, and I've showed this on my videos before as well. It's actually in my playlist. I'll tell you which one. It's in the playlist called Plus, and it is video number. I guess it doesn't tell you that. Well, I'll just show you it here. It's these videos. That one, that one, that one, and that one. So I want to give credit to him, okay? Because he's the guy that has made all of these comparisons, right? Now what we're gonna do is we're gonna look at the technicals and we're gonna look at the fundamentals and we're gonna look at how everything is similar, okay? So again, what happened in each one of these scenarios? You have expanding volatility, okay? Higher highs and lower lows, which led to a massive credit bubble. It's fueled by debt, which led to the Great Depression. Expanding volatility over here, higher highs and lower lows, which led to a massive credit bubble fueled by debt, which will lead to something. We don't know how far, but it looks the same. Now here's what's scary. This bubble was 504%. You can go and measure this yourself. It's exactly 504%. So far, we're up 504%. This bottom was at 64. I'm going to run it up from 63.90 to 64. Go back and look if you want to see it yourself. It's exact measurements, okay? This bottom right here was 6400. 64, 6400, exactly 100x. This peak was 386. Where's the Dow Jones currently? 38,600. Does that mean it's the exact same? No, but there are similarities here, okay? There was a virus down here, the Spanish flu. There was a virus over here, COVID. Going into the Great Depression, was the yield curve inverted and did the money supply contract? Yes. The yield curve inverted over here in 1928. 1928. So assuming you got out right here, or actually let's just say that you bought when the yield curve inverted, you might have been up in the short term 80%, 85%. Look, the market kept going up for a year and a half, another 80% plus. But did you know that if you bought in 1928, so we're not even picking the top of the roaring 20s, and you held till 1982, you were break even over here during all of these years, adjusted for inflation. 54 years. So picture you're 18 today and you turn 72 in 54 years, and you're break even, adjusted for inflation. The money supply contracted over here, and guess what? The money supply is contracted over here as well. Don't take my word for it. Again, here you go. Here is the data, right? We have gone back and looked. Yeah. And in fact, let's do it one more time. I'll go back and look here as well. After this, I'm zooming in because of this other picture. So the Dow Jones here only has data going back to 1896. Okay. So if we go back and look at all of these examples first, what happened in 1948 to 49? How much did the stock market decline in 48 to 49? Keep in mind, it was still down. By this point, it was still down 45% from the 1929 peak, 17 years prior. Okay. So yes, the stock market only went down 25% here, which was as bad as what we saw in 2022. Okay. What about the time before that? 1937 to 38. Again, did not recover from the Great Depression. We still fell 50%. Okay, when the money supply contracted. What about the time before that? The Great Depression. We fell 90%. What about the time before that? 1920 to 21. 46%. What about the time before that? 1893 to 94. Which again, we only have data going back to 1896. We have to look at this. Okay, I did not take this. I did not draw these lines. It's from Twitter because it was the thing I found, right? 1893. Okay, let's see. 1893 to 94. The stock market, if this was 61, again, we don't have a number up here, but we could assume if this is 61, this is probably around mid 50s, right? From mid 50s down to, well, 34 here, but 28 ultimately down here in 1896. Okay, so about a 50% decline. Okay. What about before that? 1873 to 79. That was right here, from just shy of 50 down to 25. Okay, about a 50% decline again. What about the time before that? 1865 to 67. That wasn't bad. That was right here. Okay, because this is 69, this is 57. Okay, how much did the stock market fall? 15-20%. What about the time before that? 1837. No, 1857. That was over here, from 1852 to 1857, from 32.9 down to 12. Okay, about 70% or 65% or so. And then we have 1837. How much did the stock market fall? About 70%. So you have 2 centuries, 200 years of data where every single time when the money supply contracts, you get a severe recession or depression. You get high unemployment rate with deflation. Okay? And if you don't believe me regarding the deflation, again, we'll go back and look at the comparisons. Okay? Now, another thing I want to go over right before I skip over this, okay, is the fact that, again, if we measure it from here to here, and you might not think this matters, you might say technicals didn't matter back here, you can sit here and draw your lines, imaginary lines on a chart, going back to the Great Depression, it's not going to mean anything. Okay, well then how do you explain this? And you might say, oh, this is something that you're looking at in hindsight, and that these levels were respected so well. No, it's not. You want to know why I know that? Because people have written about why they thought the stock market was going to go up because of multiple reasons. Even not using the fib extensions, but they were using other technical tools that we still use today. I'm sure maybe someone was using the fib extension. I'll show you why, because there was clearly a reaction at it. Maybe it's a thing in hindsight, but I'm not going to show you anecdotal evidence. I'll give you plenty of evidence. But how do you explain this exact confluence support level right here, which led to a 115% bounce then? Is that a thing in hindsight? Maybe. But people were still drawing lines back then on charts. Okay. How do you explain the stock market bouncing right here, 30% off of the previous all-time high here, etc. Right? How do you explain the moment, again, perfect measurement, measuring from the 1 to the 0, where was the peak in 1928? Right before, well, this was not the literal peak, but when the momentum started diverging, and I'll explain what that means. Here's the 4.236 fib extension, which again is the 1.618 on top of the plus the 2618 equals 4.236. What happened when you reached the 4.236 extension to the momentum? Price went down 15%. This is where the most amount of people were interested in participating in a move. Did the stock market go higher? Yes. But what was happening with the momentum? Again, this takes volume into account. So it sees if many people are interested in participating in a move to the upside. Okay? Fewer people are interested in participating in a move to the upside. Does that mean it can't go higher? No, but it likely means that it's not a trustable move. Okay? And it diverged and then it crashed. And then where did it reject again? At the 4.236 extension. Okay? Do we have the same thing today? Yes, we do. Now I'll even show you examples. Okay? So what we're going to do is we're going to go to the Dow Jones today. And we're going to look at the monthly. Do we have divergences all over the monthly chart? Yes, we do. If we look at it like this, you see all the way from over here. This is where the most amount of people were interested in participating in the move to the upside. As price pushes higher, okay? As price pushes higher, there are fewer people interested in participating. You keep making a high, a lower high, and a lower high. A high, a higher high, and a higher high. 3 drives of a bearish divergence, which typically leads to a complete reversal. Now what we're going to do is we're going to look at the Nasdaq, okay? Because again, and this is where I'm not the one who figured this out. I want to clarify this. In regards to, one sec, let me get the fib extensions on there as well. Okay, if we take the top here in 2007 for the Dow Jones and the bottom here in 2009, the Dow Jones is reaching the 4.236 extension right now, even though the measurement is from 07 till 09. Whereas the Nasdaq is also reaching the 4.236 extension, but the measurement is from 2000 till 2002. And we're doing it on negative divergences. And so are we with the Dow. So we had negative divergences back in the roaring 20s, which led to the Great Depression. We had a money supply contraction. We had a yield curve inversion prior to it. The numbers are the same. So again, look at this. Not only are we reaching a 4.236 extension with negative divergences, expanding volatility, higher highs and lower lows, credit bubble. Again, a quote from over here. The 1920s was all about excess. Folks to free and easy with credit and speculation. Too much inflation and debt, too much cash and too little. Sounds the same as today. We're just waiting for the too much cash and too little part. Okay? Expanding volatility, higher highs and lower lows, credit bubble. 504% rise. Bottom at 64, top at 386. Bottom at 6400. I don't know if the peak is at 30,600 right here. But the bubble is now officially as big as the roaring 20s. So for you to be bullish here, just know that the bubble is as big as over here. So yeah, you could have been bullish here, and you might have looked like a genius when the chart looked like this, right? But what happened on the right side wasn't so great. Do I think it's going to crash that much? I have no idea. I don't know. I just know that historically speaking, the yield curve and the money supply have a flawless track record, okay? They are undefeated over centuries and decades. So now what we're going to do is, again, since I mentioned the 4.236 Fibonacci extension, right? Actually, I can just do this to get my chart back. Okay. So there was a reaction here where the momentum started diverging, like I showed you, at the 4.236 extension. You might say that's anecdotal evidence. Okay, let's go over multiple charts that respect that fib extension. And I'm going to try and make sense of it. Okay? Do I know for a fact why it is that the chart respects these levels and things tend to crash here? I don't. The top here in 73 to the bottom is 74. 1987 peak, 40% collapse. Okay? We're at the 4.236 extension. What happens to other charts when they get up here? What happened to BTC up here? Okay, from the peak to the low, 70% of the losses was recovered, came back, never took out the low, 4.236. What happened to Ethereum? Even though it only recovered 23.6% of the losses, it also rejected right there. Or what about Ethereum Classic? It also rejected at the 4.236 extension. So you might say these are anecdotal evidence, anecdotal evidence, right? Well, I just showed you multiple examples. Here's another one, if you want to look at this one. if you take it from, and again, here's another way to do it. You can squeeze the 0.236 against the 0. One sec, I'll adjust this. Instead of the 1 to the 0. And you can see 4.236 extension in 2017. Okay? So we can sit here and say that fib extensions don't work and everything, but and I don't know why this is that there is some sort of reaction here, but historically speaking, you would be naive to ignore it, right? Okay, so what historically happens? Well, when price is in price discovery, do people know when to sell? No, they don't. Are algos gonna sit here and guess? Maybe. But how could we make sense of this? If 43% of all the trading in the stock market is done by algorithms, CTA machines, we could expect there to be algorithmic reaction at those extension levels, right? So now what we're going to go over, and again, I've covered this in my old videos, right? But we're going to go over this because it matters, okay? We're going to go over the inflation rate against M2. So I'll go over what everything means, okay? Okay, I'll write it down, I suppose, because it's a bit confusing. Horizontal purple line equals 2% inflation. Green horizontal line equals 0% inflation, okay? And then we're gonna put, just so it's easy to understand, right? Yellow line equals inflation rate reported by the US, okay? And orange line equals US M2 money supply, okay? What do you notice here? In March of 2020, the money supply expanded in, let me move this over. The money supply expanded over here in orange. What did inflation rate do? Initially it went down, then it came back up a bit, but when did it go above 2%? The purple horizontal line. In March of 2021, 12 months later. When did the money supply peak? In June of 2022. When did inflation peak? Again, money supply in orange, inflation rate in yellow. They peaked at the same time. So I think it's pretty logical. Most people would agree with this. If the money supply goes up, more currency units chasing fewer goods and services, you get inflation. If the currency supply shrinks, it's bad. There's two types of deflation, okay? You have productive deflation or disinflation, which leads to, oh, sorry, let me move this over, which leads to healthy deflation. Capitalism does this as corporations compete with each other. They drag down prices. Okay. Then you have monetary deflation, contraction in the currency supply. Okay. Bad because it's a debt-based monetary system. So this leads to severe recessions slash depressions. Okay. If it took 27 months from the expansion of the money supply till the peak of the inflation rate, right here in June of 2022, and it took 12 months for inflation to start accelerating, okay, it went down and hit 0 here in May of 2020. We can see there's a lag effect. When the money supply goes up, it doesn't mean inflation is going up instantly. It goes up after, okay? When the money supply started going down in orange, what happened to inflation? You saw disinflation. From 9.1% down to what they're reporting at 3%. Now I'm going to show you something else though. You remember in 2022, everyone was looking at trueflation. This is the accurate data. They're using the same data that they used back in the 70s and 80s. So when we're talking about deflation, which again always happens when the currency supply shrinks, are we seeing signs of deflation right here? Yes, we are. And we can see it right here. We're approaching deflation. We're not at the deflation point yet. We're seeing severe disinflation, and now we're below 2% inflation. We're at 1.35%. This is the accurate data. They reported higher than what the US government did back then because the US government wanted to look better, which is obvious. And do I have proof of this? Yes, because the US CPI revised down. Look at this. They are even revising it down. Okay? They are revising it down, which further proves the fact that Trueflation reports the accurate data. Okay? Now it's revised down from this. So you're starting to see, again, like the lag effects here would suggest, if it took 12 months, okay, between the expansion of the money supply till inflation went above 2%, between month 0 to 12, and this would be, well, this is where you had the initial acceleration in inflation. This is where you have the deceleration in inflation. Here's where you have the proper inflation, and here's where you should see the proper deflation. How far down will it go? Well, it depends on how much they're going to report it, right? This is the accurate data if you actually want to look at it. Everyone was looking at this back then. This is the accurate data, trueflation. It's the way they calculated everything back in the 70s and 80s. It's the non-crooked numbers, the non-cooked numbers, okay? All right. So by that logic, if it took 27 months from the expansion of the money supply till a peak, right here, for inflation to hit its peak, 27 months out from the contraction in the money supply would put you in September of 2024. Do I know if we're going to see deflation by September of 2024? Well, look at the trend. What is this suggesting? And I made videos about this 2-3 months ago, talking about we're going to see deflation Q3, Q4 of this year. If we don't, this time is different, and something has fundamentally changed. The business cycle has been repealed, interest rates no longer matter, which means gravity doesn't exist, because interest rates are gravity for stocks, but with a lag effect, okay? And then you're going to say, yeah, but the unemployment rate is low. No, the unemployment rate is not low. Okay, we're going to bring up many things here. We're going to look at Cisco layoffs. Cisco cutting tens of thousands of, it's 10,000 jobs, okay? And then we have UPS layoffs, 12,000 jobs. Is this signs of a strong economy along with we're approaching deflation? I don't know, maybe it is, right? Why is the California unemployment rate going up? Again, I was covering this over half a year ago. Every single time the California unemployment rate goes up greater than 0.3%, we get a gray bar, which is a recession. Here it went from 9% up to 9.3, no gray bar. Here it went from 7.8 up to 8, no gray bar. Every other time it goes up greater than 0.3%, we get a gray bar, which is a recession. But this time I don't think it will be a recession, it will be a depression. Why do depressions happen? Because of malinvestments and because of zombie corporations, and bad debt never gets wiped out. So when the crisis hits, it's way worse than what anyone expects. Okay? Here it has gone from 3.8 up to 5.1, and it keeps going up. And you see this. These are not small job cuts, okay? Does this happen in a healthy economy? I don't think so, okay? Then the second example, which is what I like to go over, yeah? And again, I'm only showing you data, I'm not giving you my opinion. 100, this is in millions, okay? Full-time jobs. Employed usually work full-time. From the Federal Reserve's website, from the St. Louis Fed Economic Data Research website, okay? 134.7 million down to 133.2 million, okay? Adjusted for population growth, this is worse than anything in 2008. The worst month here, you can go look at this yourself. From 118.4 million out to 117.1 million. Back then, US population 2008, 300 million. Today, 330 million. So add 10% on top of this increase, okay? So if the decrease in full-time jobs, okay? Say if it was 1.3 million job loss from 118.4 down to 117.1, add another 10% on top of that, 1,430,000, right? Is that as bad as what we saw last month? 1,530,000. Why are we losing 1.5 million full-time job loss in 1 month? And why do we see these headlines? And why is inflation approaching deflation if this time is different? Do you see the flaw in the argument for this time being different? And do you see the lag effects? It's objective facts, okay? This is data. And over here, they reported high inflation, or I mean, not, well, there was high inflation, but it wasn't as high as it actually was. True inflation, I think it was 13 or 14%. You can see the aggregated inflation rate and everything here too. Okay? So sitting and betting on this time being different, you can do that. Just know these are the facts. This is the data. Okay? And again, I'll show you a couple of other examples. What we're gonna do is we're gonna go over to this. Give me 1 moment. I'm gonna bring up a couple of pictures. And again, I think this one alone, since I'm talking about the Great Depression, you know, hours worked to buy the S&P 500. Even during 2009, we weren't cheap. You might think it was cheap. It wasn't actually cheap. Okay, for the stock market to get back to the average, the stock market would have to crash 80%. Now, if you think that this is sustainable, I'll explain why it's not sustainable and why this can't continue, okay? I think everyone knows to some extent that it's not sustainable, but why this has to end pretty much right now. In 1938, the cost of living was 3,900 for a new house. The average income 1,700. Okay. Well, what's the issue? If you look at the U.S. debt clock today, okay, and ignore the U.S. national debt and everything, median income now 39,000. Okay. Median new home now 420,000. It's 11 times the annual salary. Okay. Over here was 2x. What is the problem with this? Well, what problems do Japan? What problems does Japan have? They have a aging population and they don't have younger generations to replace them in the workforce. Okay, so what happens is you have a scenario where the economy can't grow. And why would this happen? Based on what I'm showing right here. If you want to have kids, you likely want to have a home. Why would you want to have a home? Well, because it's a better environment for your child to grow up in. Okay, so they are the central planners, the central banks, the government, they are contributing towards depopulation. Um, and this fucks up demographics. There's not a way of putting it. It screws up demographics because people are now not going to want to have kids, right? It doesn't work. You can't create the economy that sustains itself off of zombie corporations and unproductiveness and malinvestments. You can't do that long term. It doesn't work, man. Just look at Japan. And they might say, yeah, but they're just going to expand the money supply. Well, look at China. Again, we can just look at the data here. Look at the Hang Seng Index, okay? They're experiencing deflation right now, by the way, okay? With a money supply that's going up. But look at this. They're 50% down from the highs here in late 2007. What has the Chinese money supply done since then? Don't take my word for it. Since late 2007, it's up 630%. It's up even more now. 640%. And yet the stock market is down 50%. We're seeing all the warning signs. It's just up to you if you want to look at it. But because the stock market is going up, everyone is really happy and all, right? Well, look, if you think that this is sustainable, right? Maybe it is. Maybe this is the future and it will just go up only. But if you think this is normal, and again, it's a multi-trillion-dollar company, okay? I read some news headlines that it's Nvidia's market cap is as large as the whole Chinese stock market. I don't know, maybe it's sustainable, right? But if you think this is sustainable, that's fine. Um, but more often than not, these type of vertical moves result to the downside. And if this was pushing up the stock market, when we're talking about a crash like 1929, if this is what's holding up the stock market, because most stocks are not doing well, hence why the IWM is where it is. This is the small caps. This is the real economy, okay? Well, the market's never the economy, but this represents the average business, okay? Then why is this not breaking out, okay? Well, it's because things like this and this are taking over, okay? But if this reverses, this hockey stick move, to some extent, the stock market will not hold up well. There's a quote, permanently, Irving Fisher, permanently high plateau. Yeah, look at this. Stock prices have reached what looks like a permanently high plateau. I do not feel that there will soon be, if ever, a 50 or 60% point from break from present levels, such as the bears have predicted. I expect to see the stock market a good deal higher within a few months. When did he say that? In September, I think it was in 1929, a month before the stock market crashed. No, it was October 16th. It was literally 2 weeks, or no, it was like a week before October 24th, 1929, when the Great Depression began. With Black Thursday, I think it was, right? Yeah, and then Black Tuesday the following week on October 29th. So he said this literally a week before the stock market crashed. I don't know, bro. I mean, you do what you will with all of this data. I'm just sharing information. I'm not telling you what's gonna guarantee to happen. I'm telling you what always happens. And again, you can sit here and say that this time is different. That's fine. Just know what you're betting against. You're betting against a yield curve with a flawless track record. And this is completely normal what it's doing. you're betting against that, which historically speaking isn't a very good sign. And you could have said the same thing back then. And again, just to put this into perspective, we could all agree that Microsoft is a great company, okay? But if you bought it in 99, yeah, and you held it till 2019, you broke even adjusted for inflation in 2019. 20 years in arguably the greatest company of all time, along with Apple and I guess you can say Nvidia, whatever, if you're into that, right? But it's one of the greatest companies of all time. And again, same thing if you bought in 1928 when the yield curve inverted and you said this time is different, the yield curve doesn't matter, and you held till 1982, you broke even after 54 years. So if you're fine waiting 54 years just to break even, adjusted for inflation, that's great, but why? And does this really look different to this? No, it looks the same, right? So I think I've covered most of the things here. I'm trying to remember if there's anything I've forgotten. Well, again, I'll just go over all the pictures, right? Since, you know, I guess I'll fit everything into this video. Where is it? Here is one, and here is one. Soft landing hopes and hard landing realities. Soft landing, soft landing, recession, recession, soft landing. Well, we're seeing the warning signs, right? Etc. California unemployment rate, full-time job losses, all that. And then people will say, yeah, but this time I really do feel like it's different. Well, they always say it's a soft landing. Soft landing expected 1973, recession. 1980, recession. 1989, recession. 1978, recession. 2007, recession. 2000, recession. They say the same thing every time. Soft landings don't happen. And people might say, yes, uh, they do happen, okay? Look, the Fed dropped interest rates over here. And here's another thing. We actually need to go over this, okay? Really important. People look at interest rates, the change in interest rates as... I have a lot of things to cover on this. I don't know if I want to go over everything though. But as interest rates are just going up from 0% up to 5.3%, and it just looks like this on a linear scaling, right? But if we go to logarithmic, what do you see here? This change from down here to over here is way more severe, relatively speaking, than any of these changes over here. This right here will lead to consequences. Why do we have to look at this from a logarithmic point of view? Because this is how debt is calculated on a relative basis. This is the way this is the lens you should view interest rate through on a logarithmic scaling on the Fed funds rate. This rise right here is way more severe than anything over here. Plus it happened way quicker. Okay? And the national debt is over 3.5 times as big. Or it's 3.5 times as big. From 10 trillion over here, or just south of 10 trillion. And here it's 34 trillion. So going back to the point I was trying to make, people say, yeah, but here we had a soft landing. Well, again, was the yield curve inverted over here when they were dropping interest rates? No. Was the yield curve inverted over here when they were dropping interest rates? No. So they were dropping interest rates, yes, but it didn't lead to a recession. Why? Because the yield curve was not inverted. Okay? So yeah, and by the way, soft landings, they actually do happen, and we're in one. Well, we have been in one for like the past year and a half. That is the transitionary period from the economic expansion to the economic contraction. Okay? Again, respect lags. When we talk about lags, and I showed you all of the data in regards to the money supply and everything, and how long it takes for these things to play out, take it from the greatest economist of all time, right? There is much evidence that monetary changes have their effect only after considerable lag and over a long period and that the lag is rather variable. I have been collaborating with Mr. Schwartz. We found that on average of 18 cycles, peaks in the rate of change in the stock of money tends to precede peaks in general business by about 16 months, and troughs in the rate of change in the stock of money to precede troughs in the general business by about 12 months. For individual cycles, the recorded lead has varied between 6 and 29 months at peaks and between 4 and 22 months at troughs. Monetary and fiscal policy is rather like a water tap that you turn on now and then that only starts to run 6, 9, 12, 60 months from now. It's because there's a long lag in the reaction to policy that you tend to have this tendency for policy to in fact have an effect opposite to that intended. Or again, thus you have a situation such that when the Federal Reserve System takes action today, the effect of that action may on some occasions be felt 5 months from now, and other occasions 10 months from now, and other occasions 2 years from now. That is the major reason why it is so difficult as a technical matter in the present state of our knowledge to know what measures one ought to take at any given time. Okay? So you can bet on this time in the front. And maybe you're right, but you don't have a single example to point towards, historically speaking, where the yield curve inverts and the money supply. Again, these are two things to 100% accurate, flawless, undefeated economic indicators. What is your argument for why this time is different? Can you give me an argument? If you just say this time is different, there's no validity to it. You need to point towards data and show me the time where it's been different in the past. And again, the Fed does not control interest rates. I keep going over this, okay? If we overlay the Fed funds rate, and then we're going to look at what the stock market does here as well, okay? And when the stock market tends to care about interest rates declining, you need to view interest rates through the lens of it's about growth and inflationary expectations. If interest rates are coming down, it's because the economy is weak. It's the opposite of what people believe. And I can prove that with what happens historically speaking. Stock market drops when interest rates come down. Why? Because they come down because of bad reasons, because it's about growth and inflationary expectations. If there is contraction and deflation expectations, that's not good. Interest will come down, yes, but it won't be because of the good reasons. Okay? Here the regular candles go down, that's the 2-year treasury yield, and the Fed funds follows. Here the regular candles go down, the Fed funds follows. Here the regular candles go up, the Fed funds follows in orange, yeah? It's the Fed funds. Here the regular candles go up, Fed funds follows. Regular candles go down, Fed funds follows. Regular candles go up, Fed funds follows. Regular candles go down, Fed funds follows. Regular candles go up, Fed funds follows. Regular candles go down, Fed funds follows. Regular candles go up, Fed funds follows. Regular candles go down. Up here, what was Jerome Powell saying here? This is why it's such a clown show, right? He's saying, oh, I like higher for longer. As soon as the 2-year dips, he goes, we're talking about the interest rate cuts. Because they're not in control, they're just following the 2-year yield. How can I prove that? Take it not from me, but from the Fed share during the Great Financial Crisis. When I was at the Federal Reserve, I occasionally observed that monetary policy is 98% talk and only 2% action. The ability to shape market expectation of future policy through public statements is one of the most powerful tools that Fed has. They don't control interest rates. I just proved it to you with a chart. Okay, so now understanding that the 2-year yield will forecast, which again is the yield curve. Okay, well, the yield curve is the spread between the 10-year, 2-year in that example. When did the stock market care, historically speaking? The stock market liked when interest rates were going down here. The 2-year was going down from June 06 until October 07. The stock market kept going up for what, 16 months? When did it start to care? When did it make the first official low? When the 2-year took out this low and went sub 2.9%. Again, we have a perfect reference point. 5.283 is where the 2-year got up to here, and here it got up to, again, you can see the valuation up here, okay? 5.259. So it's the same, more or less. 5.283, 5.259. Okay. When did the stock market care? Over here. When it took out this low and the 2-year went below 2.8%, 2.9%. Okay. So when would the stock market care? When this gets taken out on a 2-year, or here, if the same scenario plays out. And it looks like we're repeating something very similar. And again, if you don't believe me, you don't have to believe me. Just look at the data. What does the data tell you? When interest rates come down, okay? Just look at the 2-year even. When a 2-year crashes, is it good for the stock market? Was it good here? No. Was it good here? No. Was it good here? No. Was it good here? Well, we don't know yet, but probably not. No. What about in the past? Was it good here? No. Actually, it wasn't here. It was here. Here. The 1990 recession. Was it good here? No. And then I guess the 2-year doesn't go further back. We'd have to look at that 1 year or something. But the point being is, when interest rates come down, it's not good. And you can see, like when interest rates go up, the stock market does well. 2-year up, stock market likes it. 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 It likes higher interest rates because it means the economy is strong or stronger. It can absorb it at that time. But when interest rates come down, it's bad because it's about growth and inflationary expectations. Okay? Of course you can bet on this time being different. But with all the data I've showed, all the evidence pointing towards the same thing, does it really seem like a good idea to bet on this time being different? It's up for you to decide. I showed you all the similarities. I showed you the historical data, going back decades and centuries. Don't listen to what I think is gonna happen. And by the way, I want to clarify this by closing out the video. I don't want bad times to come. I would prefer a soft landing and good times. Okay? I would prefer that. But it's not about what I want. Okay? And I don't care if this market goes up or down because I'll make money regardless. Again, I even showed you that right here. If it's gambling, why am I green 35 out of 36 days here recently? I don't care if the market goes up or down. I really don't. I'm just sharing this because this is a hobby of mine and I like to look at data, right? I would prefer if this doesn't happen. But historically speaking, this does happen. I don't want this shit to happen, but it always does, and it's naive to ignore it. And when we're seeing all these warning signs, you can keep ignoring it, but I don't think that's gonna be a good idea, man. And it's Microsoft is also doing layoffs and shit. Like, look at this, man. It's not just one company; it's a lot of companies, bro. Right? Why are we seeing layoffs in such a strong economy? Layoffs don't just randomly happen. Sure, sometimes they may do, but now we have a lot of the big companies that they're all reporting layoffs at the same time. Why? Because something is wrong. It's simple. Okay. Was there something else I wanted to go over? Probably not. Yeah, if there's something I forgot, I'll leave it in the pinned comment below or something. Take care.